Today I look at a bias I call the positive outcome bias. This is a bias that comes into play during the strategy development phase and revolves around a propensity for the brain to focus on the desired positive outcome more than the negative outcome. And this can hinder the strategy development process for many traders. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. Those of you that saw my previous episode about survivorship bias will remember the analogy I drew with warplanes. While today I use the same example to illustrate what I call positive outcome bias and the need for all developers of trading strategies to look past the obvious. Let's take a look. When we considered survivorship bias last time, there was a great analogy with the analysis of the damage of warplanes returning from missions. And we looked at the work of Abraham Weld from Columbia University, who suggested it was the parts of the plane that had no damage that were the ones that needed to be reinforced, as opposed to those that did have damage. And this all revolved around a bias brought about because it was only the planes that survived and returned that could be analysed. And we looked at how this was analogous to the stocks in a stock index changing over time and the kind of bias that can produce when backtesting using the stocks in the current index. And just like it was essential there to look past the obvious, the same principle applies, be it in a slightly different way, to this next analogy, which is the positive outcome bias. Now, this is something that comes into play in the early stages of the development of a trading strategy. And if we take a look at the trading evolution cycle that we've been studying in previous episodes, this happens at the very beginning when a new trader is developing their first strategy, but can also play a part in subsequent developments later on in the cycle. So let's take a look at a price chart and go through the process that a trader might go through themselves when trying to come up with a viable strategy. And I'm going to use a really simple moving average crossover system to illustrate the point. Now, when you look at this chart initially, the focus tends to be drawn to the nice big trends on the chart because, of course, they're what the trader is attempting to exploit. And if we take a look at this, we see that the faster moving average crosses over the slower moving average at this point here, and then it doesn't cross over back again all the way until here. And so this would produce a nice profitable trade. But there are two things that I want to highlight here. The first is that traders tend to focus too much on the indicators and not enough on the price action. And I've talked in previous episodes about how that's a huge mistake. You have to stay focused on the actual raw price action whenever you perform any analysis of this sort. So by focusing on the indicators, the rules of the strategy mean that the user is focusing on the points at which these cross over, which of course is here and here. And it's almost the gradient of this line that many traders see as opposed to what is actually happening to the price action. And so when performing this kind of analysis, it's essential that you look at where the price action is at the point of the crossover. And of course here, the trader gets in at a less preferential price than at the level of the crossover itself. Equally, when the crossover occurs here, it's actually occurring when the price action is all the way down here. And so it's this green line that the trader needs to focus on, not the red. Now, that all might seem fairly obvious, and you might think that, well, it doesn't actually make very much difference. The trade is still extremely profitable. But let's now take a look at another part of this chart, which is this crossover here. Now, let's just make this a little bit bigger. And here we see a crossover here with another crossover here. And again, naturally, the trader's eye, when they're going through this process, is focusing on these crossover points. And the line between the crossover points is up. But let's force ourselves to look at the price action instead. So at the point this crossover happens, the price is actually up here. And then if we look at where the price is when the crossover occurs in the opposite direction, it's somewhere about here. So although we see a nice healthy uptrend on the crossover points, the reality, if you were to take this trade, is that it would be a trade that lost. Now, I've just used an example here of a simple moving average crossover, but the same applies of many different types of indicator. And when the trader's focus is too much on the value of the indicator and not the price action, this is when this bias can occur. Now, I said there was another type of positive outcome bias, and that is simply that when a trader is analysing a chart in this way, it tends to be these big trends that a trader will focus their attention on, because this, of course, will produce a trade with a high profit. However, if we take a look at this part of the chart here, for example, where the moving averages are continually crossing over throughout this trading range, much less focus tends to be given to these areas when the trader's considering the rules that they will implement, and the eye again gets naturally attracted to these bigger moves. But of course, every time that these two moving averages cross, this will incur a loss on the account. And although they look much smaller, these all add up and they will significantly impact the longer term performance of a trading strategy. And so again, the user has to bring themselves back and look at these negative aspects of the trading rules that are being developed, as well as the positive. And if we think about it, that's exactly what Abraham Weld had to do when he was analysing these warplanes that were returning from missions. Although he only had the planes that survived to perform his analysis, he had to infer where the planes that didn't come back had been hit by looking at the undamaged parts of the planes that did. Now, we're coming to the end of this series and we have just 2 episodes left. And in those, I'm going to be looking at backtesting, optimization and overfitting. And then in the next, diversification and risk management. And just as a reminder, after this series, there'll be a new one on institutional grade risk management techniques. And in this, I'll be looking at some of the more sophisticated techniques that are very often used by trading institutions, but much more rarely by retail traders. But this is something that can potentially set you aside from other traders if you implement them. So once again, thank you for your time today, and until next time, trade safe.